Hi, welcome to Closing Time with Jeff West. This is episode 3. I'm a local real estate agent here in St. Thomas and Elgin County. And if you're thinking about buying or selling real estate in the area, today's going to be a very, very educational day. I've got Mike Rogozynski here, who's a local mortgage broker in St. Thomas, and he's going to introduce himself, and then we'll just have a little chat.
Hey, Jeff, thanks for having me. Hope you're doing well today.
Thank you.
As Jeff mentioned, my name is Mike Rogozynski. I've been a mortgage broker for just over 32 years. I've seen quite a bit of activity over those years. I have offices in a couple cities, Woodstock and Tillsonburg, and I work from home in St. Thomas as well.
Nice. Now, Mike, I get phone calls all the time from potential buyers, sometimes first-time home buyers, just asking, how do I go about getting pre-qualified and or pre-approved? Can you touch on it a little bit about what that looks like?
Yeah, for sure. So there's basically two differences. There's the pre-qualification, and which basically is when they analyze your income, your outstanding debts, monthly liabilities, and tell you what you can afford to buy. The main difference between that and the pre-approval is with a pre-approval, a credit report is actually pulled. So that's very important because that way, if there's any issues that show up on the credit report, these can be addressed. And when the client gets that pre-approval certificate, it basically means that, they're in a good spot and they should have no problem with the mortgage approval once they find the property they're looking for.
Yeah, right. So when they reach out and call you and say, hey, I'm interested, what's your first step with them?
So basically, when I get a phone call, I ask, what they're looking for. Is it a purchase, a refinance, a switch transfer? Once we know that, we can kind of direct things in the appropriate manner. The first step is always getting the mortgage application. It's very strict. We have to have their signature to use their information, to do a credit check. So what I normally do is I direct them to my secure website, and then they would complete the application. Once they hit submit, it comes right to me, and then I hit the ground running. So I've got the basic information that I need, and then I'll follow up with them if there's any additional information. But because of that application, it's in depth enough that it gives us the information to figure out, again, can they be approved? And then so based on their debt load, okay, what do they qualify for? Or give them a plan or direction on how to get to the point that they want. Because sometimes they'll come to us and they say, I want to buy a house for $800,000. Did they qualify for $600,000? So sometimes just setting those realistic expectations also helps you as well, because then, they're directed to the property range that they can look at, and then you've got a better understanding of where they sit and what properties you can show them.
Right. And I know kind of the biggest thing, right, is their debt, their income, to determine how much they're going to be pre-qualified for or pre-approved for. When you give someone the number, so they're pre-approved for $600,000. Is that something that they should start looking at houses that are listed for $600,000?
Yeah, realistically, it depends on them, and how much they want to spend. A lot of first-time home buyers and actually just repeat buyers in general, they have a certain price that they want to buy, but also a certain payment that they want to stay at. So, even though I might qualify somebody for $800,000, realistically, they only want to buy for $600,000 because it meets their needs as far as what their monthly obligations are. It's a little scary when you tell somebody they're approved for, let's say, $600,000 and they buy for $600,000. Problem with a pre-approval, in my opinion, is that it's generic. It's based on principal, interest, taxes, and heat on the property they're buying, plus their debts. It doesn't take into account, home insurance, car insurance, gas, daycare. So they should have a budget as well, which they want to follow, because those two things hand in hand will determine if they're house poor or if they're going to enjoy owning their home.
Right. Yeah, no, that makes perfect sense. And is there, how much money do people... I get this a lot from people when they call and say, I'm really interested in this property and I've got so much money saved. I know it's really difficult right now, if not impossible, if they don't have a down payment, other than a couple of plans we're going to talk about later. What kind of advice do you give them when they call and say, okay, well, we don't have the funds, the money saved up, but we have good income?
Yeah. So realistically, I never tell a client no. I just may say not yet, because that's important. You don't want to discourage them. They're going to be discouraged regardless if you can't get them to the price range they want or they can't get into the housing market. But we try and put them on a plan. So, try and put so much away every month, and something maybe that'll grow that nest egg a little bit further. But at the end of the day, They have to have 5% down payment. That's the minimum, up to 500,000. Once you get above that, there's a little bit different formula. It's 10% on any amount over the 500,000. So, that's where it helps to have somebody in your corner that's kind of helping you figure out where you need to sit and what you need to save. But 5% is the minimum. And again, we'll get to those other programs you're talking about. But if they can't come up with that, we encourage them maybe talk to a relative, immediate relative. Maybe there's a gift that can be given. There's different ways to try and get them into the housing market, but realistically, the lenders want to see that they have some skin in the game. They've been able to save some funds, which is easier said than done sometimes. Now, having said that, I can say in the last probably 5 to 6 or 7 years, we're seeing a lot more savings with first-time homebuyers getting into the market. They've been able to buckle down and they've made it a priority that they want to save. So I'm seeing clients, that have 10% down, some with 20% down. So realistically, it's going to depend on their job, their other expenses, but the more they can save, the better position they'll be.
Yeah. And just with my experience, and I've learned over the years that there's certain things I tell my clients, which I'm sure you do as well, Mike, and, they get pre-approved and pre-qualified and then they make some mistakes. Go buy a new car. Have you found that happen, I'm sure, over the course of your experience?
Yeah, over the course of my career, I've had, every probably situation you can possibly imagine. But we're pretty strict when we tell our clients when they're pre-approved, don't go anything that changes your financial situation. Don't incur more debt. Now, some things are out of control. If their vehicle breaks down, they got to buy another one. Well, we encourage them to call us, just figure out what payment might not impact things as negatively. The funniest thing is, or the most frustrating thing I see is when clients come to me to get pre-approved and they've just went out and bought a truck and the payment's $1,200 per month. And then they don't understand just how negatively that impacts things. The total debt service ratio is there for a reason. It's to make sure that, not only can they afford the housing expenses, but can they afford their debts and their monthly obligations over and above. So, that's a big one. Don't incur any other debt. Don't miss payments. There's lots of things that we try and counsel them on. If you're going to change jobs, please talk to us first. There's things that can negatively impact their pre-approval. And I've had it where, unfortunately, then the pre-approval doesn't exist anymore. So it's more of that two-way communication, and we encourage it. I tell my clients, call me with any questions. There's no dumb questions. I want to make sure that they're keeping themselves in that position to buy that home that they want.
Yeah, for sure. And I do think it's important too that, and I know you do this, Mike, like when I'm talking to my clients and, they're pre-approved for say 700,000 and we go look at a house that's 685,000 and they think they can go in with a firm unconditional offer because they're pre-approved, but that's not necessarily the case, correct?
Yeah, and you and I know that with every one of my clients that we're dealing together on, I always say just make sure there's a financing clause. If it needs to be shortened because there's multiple offers, by all means, we can try and work with it. But the challenge with going in firm is that they're obligated to buy that house no matter what happens. So let's say it's an insured mortgage and the insured doesn't like the property, or an appraisal is required and the value's not there, or they don't have their documentation in and they've stated their income at one thing and it's something different. And the income is a big one where it changes from when they do the application sometimes to when we get the documentation. And we tell them, okay, if you're paid hourly, great, we can do the number of hours per week times your hourly rate times 52 weeks a year there. It's pretty easy to figure out the income. But when there's bonus or overtime, a commission, sometimes they don't tell us that, and I'm human. Sometimes I'll forget to ask, okay, does your compensation include this? And all of a sudden, their base income is so much lower than what their actual income is. Then we have to look at a 2-year average. Well, if the 2-year average isn't still at that same income level, it can impact things. So we typically ask for income documents up front for that reason. It just makes that pre-approval a little bit more solid.
Yeah, absolutely. And there's also, I know there's a lot of not hidden, but I guess fees that people that are selling their home and buying their home aren't aware of when they're purchasing, especially if they bought, like they're in their first home they bought 20 years ago and they're moving for the first time, they're downsizing or whatever. Can you touch upon some of those things that you have to deal with?
Yeah. So when somebody's selling a home and purchasing a home, the first thing I'll ask them is, okay, well, how much of a down payment do you plan on having for the purchase? It's just a starting point. But then we want to figure out, okay, based on, if you sold your house for this much, what's your existing mortgage balance? Because if you're not up for renewal and you're not in an open term, you're going to have a prepayment penalty, whether it's 3 months interest rate or the interest rate differential. We want to know that. So we need to know what rate they're paying on their current mortgage, how much longer they have. Then we want to take into account, okay, you've got your real estate fees on the sale plus HST. You've got legal fees. And then on the purchase, you've got land transfer tax and legal fees. If it's an insured mortgage, you've got the PST on the insurance premium. So there's a bunch of different costs. So I try and break it down, because the worst thing that can happen is they get to the closing date and there's not enough funds to close this transaction. And I've seen it in the past, maybe not with my own personal clients. Sometimes bridge financing is required. Well, the way a lender does bridge financing is a different calculation of what, you might be anticipating. So there's a lot that goes into somebody selling and purchasing. And unfortunately, I've seen individuals in the business that don't go through that. And then you get to closing and there is that shortfall. That's never an enjoyable day for anybody involved, whether it be the realtor, the lawyer, the broker, the client especially. It can just create problems upon problems.
For sure it does. Yeah, 100%. And I'm glad you talked about bridge financing. In my first episode, we had Candace Watson on, who's a local realtor here a local real estate lawyer here in St. Thomas, and we talked about bridge financing, because it's often very, very difficult with same day closes. So do you want to talk a little bit about bridge financing, what that looks like? Maybe if you can give a ballpark idea of what it might cost. I know it depends on what's owing and
Yeah, I'm surprised more people don't bridge, to be honest, because it's a good tool and it gives them the time to get out of their home, maybe tidy it up if they wanted, and then get into the new home and move over a few days or a week or whatever it takes. So most lenders will offer the bridge financing. Setup fees can be anywhere from $0 to $500, and then you're going to pay interest on the amount you're borrowing. So it's just a down payment amount, basically, that you're bridging, and maybe some closing costs. So lenders are typically between prime plus 2, I think, to prime plus 5 or prime plus 4.5. So, and it's for each day that you borrow. So, that interest cost in a lot of cases isn't that much, but it's nice to have that extra time to move. The challenge is that a lot of lenders, when they do their bridge financing, they may say, okay, well, we're going to take 7% of the sale price for closing costs and real estate fees. Well, realistically, that's not the case. If you've got somebody, who's selling, the real estate may be 4%. And then so they'll tell us, okay, get the lawyer's trust ledger. If we know that the real estate fees are less, what the legal fees are, then they can reduce it and increase the amount of the bridge. So that part is a little tricky, but that's why, you have your lender, your broker, working on that for you, so that, again, you can make sure it's seamless. And when you get to the closing date, the money's there. And basically you pay for that bridge while you have it. It's paid out when the sale actually closes, when the sale closes, because bridge is required when you've got, the purchase closing date is sooner than the closing date on the sale. The key point with bridges, you have to have firm sale, the purchase and the sale agreement, like properties. Now, that's not set in stone. There are some lenders that will do bridge financing without it, but it's very costly. So, I tend to just do the bridge financing when there's 2 firm agreements in place.
Okay. So from a real estate agent perspective, you have a client that wants to bridge finance. They've got the pre-approval in place and you have them all set up. You've got 2 conditional offers, one on their sale, one on their purchase. Is there a way for you as a mortgage broker to tell them that, basically you don't think pre-approval is going to be an issue, or is that impossible to determine until it's firm?
We have a good idea if things are going to go the way we want them to. So, unless there's something in the client's, profile that may be cause for concern. But if we know that, we usually tell the client up front. Like sometimes their credit score is a little on the lower side. Let's say, 620 or 600. And usually the lender will say, okay, it's pre-approved pending insurer approval when the deal goes firm. So we tell the client that, okay, the insurer may request a guarantor or cosigner, or they may have an issue. And that's one of the reasons that I want that financing clause. Now, credit scores today are higher than they used to be. Most people are paying attention to their credit, which is a good thing. But if the client's solid all around, I can usually tell them, I don't anticipate any issues. And that's where I may say to you, Jeff, just get me 2 days, 3 business days for financing, because I know it's going to be done relatively quick. The other reason we ask for it sometimes is because in a busy market, lenders don't have the same turnaround. Normally, we're getting 24 hours to 48 hours for an approval. If it's busier, sometimes that's 3-4 days. Documentation review is even worse. It's, normally it's 48 hours, but sometimes that 48 hours is 72 hours. So we just want to make sure that, we've got everything to protect them. And that's our job as a broker, is to protect our clients, protect you. Nobody likes a lawsuit when things go sideways. I've been fortunate enough, again, knock on wood, for that not to happen. But it's just taking that extra due diligence, right? So, normally if somebody's pre-approved, they're probably going to be okay with the actual firm deal as well.
Right. Right. And so kind of you just helped out one of my clients on a bridge financing situation, and they were thrilled. I mean, they had a weekend to move, they had 2 extra days, and the cost was not that great. And I said to them, geez, it probably cost you as much money if, for whatever reason with the same day closings, where they're tricky is the funds have to go in on their purchase in order for on their sale in order for their purchase to firm up. So it is tricky. And I've been in situations where the funds aren't there in time, and they've got a moving truck full of their belongings, which has to be stored in London overnight. And the cost of storing the furniture and moving everything was actually more money than the bridge.
Yeah. Yeah. I typically say, if, if you can get your bridge financing for under $1,000, which most times it is, because most people aren't bridging, for longer than a week. I've seen them 2, 3, 4 weeks, and that's certain situations where it is, and it can be a little bit more costly, but again, it's still peace of mind, and the client's financial position will dictate, how feasible that is for them. But if you can get, 4 or 5 extra days to move, to me, it's worth it. Like every day of the week, I would pay that. I think it's a much more relaxed process.
Mm-hmm. Yes, it is. And I hire a cleaner for all of my sales. So when the property closes and when they've got 3-4 days, it makes it much easier to get the cleaning crew in there.
For sure.
The same day closings are terrible because they basically have to be in there while the movers are there, try and work around them moving a couch out. And it's hard. I want the buyers that are buying my listings to be happy when they move in and have a clean house. And with the same day closings, it's next to impossible.
Yeah. And it's funny, still the majority of those deals are same day closings.
Yeah. 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 Well, I'm glad I had the first meeting with Candace, because she really talked about kind of the importance, if you're in a position to bridge, that it's a really good option. And I think it makes the lawyer's life easier too.
Well, yeah, Candace is great. She's very good with the clients, and even the communications to me that, hey, this deal is funded. Like, you don't see that with a lot of the other lawyers out there. So Candace embraces the process just as much as you would and I would. It's nice when everybody working for the client is all on the same page.
Yeah, I'm very blessed to have a good team. That's for sure. Now, a lot of talk in the media about interest rates. It's a constant. Are they going up? Are they going down? And this has been. I barely heard about interest rates pre-COVID, and now it's all you hear about on the news, and the general public they just don't know what to do. Like, should we do a fixed rate? Should we do a variable rate? What are our best options? Is there something that you're suggesting at this point for people that are, especially people who are up for renewal and don't know what to do?
Yeah, it really depends on somebody's risk tolerance. If they've got a little appetite to gamble, the adjustable rate's a good way to go. To me, the adjustable is the better of the two options at this point. When I say adjustable, some refer to it as variable. There's differences in those two products, but pretty much the same as far as how the rates work. If the Bank of Canada is holding rates steady, then, that's a good thing for anybody in adjustable rate. And I think that's the forecast right now. So, we're seeing adjustable rates at, prime minus 0.75, prime minus 0.8, which today is putting that rate at, 3.65%. Whereas a 5-year fixed, for example, you're looking at, let's say, insured one 4.39. So there's a good amount of savings there by going adjustable. But again, you have to have the risk tolerance. One of my colleagues, he uses the analogy for his clients. He says, okay, well, when you go to Vegas, do you go to gamble or do you go to watch the shows? If you want to watch the shows, maybe just take that straight. If you're going to go adjustable, then you're a gambler. So I tend to like the adjustable. It's not for everybody, because as the prime rate changes, your payment will change. But as long as you can tolerate minor fluctuations, which typically what it is, I think it's a good way to go.
Okay. No, that's great. That's great. And I'm glad you mentioned what kind of the current rates you're seeing now, because I know a lot of people are asking that. And historically, the rates are great.
Yeah, they're
Um,
still quite low. Historically, when I got into business, they took an average, and, the average 5-year rate was, over 8% or something. It's got to be closer to probably 6% now. So they are low, but people are so short-term focused that they remember 189, 179, which they were, COVID times. But they're all coming up for renewal, or have already. And, they're now double or more than double what they were paying. So, people complain about the stress tests that was put in, to protect people. Well, people at that point, when they got those rates, they were qualified at, 4.5%, 5%, let's say. So, they can handle the payments. It's just the budgeting had to change. So, the rates are good. That's all I can say. They're decent. Would we like them lower? Sure, everybody would. Especially with the prices where they are, it enables them to qualify for a little bit more.
Yeah, yeah, no, for sure. And it's like the cost of groceries have gone up, the cost of gas going up, everything going up, and we're seeing that, the purse strings are getting pulled a little bit tighter on everybody, I think. I'm starting this year. I've had a lot of awful conversations, unfortunately, with people that bought during COVID, whose rates have gone up, and they can't afford, or they don't feel that they're comfortable enough to be making those payments and want to sell.
Yeah.
Which is difficult to have those conversations, to explain to people, well, I'm really sorry, but you're not going to be making money on your sale. However, you're buying in the same market, so you will be able to buy something at a lower value that was much higher during COVID. And a lot of people are really good, and they understand that. Are you getting a lot of phone calls from people that are looking at, okay, what should we do here?
Yeah, we've been seeing lots. We've actually been doing lots of refinances where people are trying to improve their home, because for them it's a more viable alternative than possibly selling and purchasing. But you're right, the values have gone down. So anybody who bought post COVID or during COVID, they paid a premium for that. Housing prices are still higher for anybody else before that, let's say, that bought. So their investment's good, but it's that short window. And it's frustrating when they say, okay, I want to sell, and either they owe more on their mortgage than their property's worth, or there's just not enough equity to give them a down payment to buy something else. And the flip side to that too is, let's say they can, and they're going to rent. Well, then the rent is higher than the mortgage. So it's kind of that perfect storm where there's no real solution for some people other than buckle down and make your payments, and figure out ways to do it. It's got to be stressful for those individuals that were tight when they bought at 1.79. And again, as I said, that's why a budget's very important, because when we're doing our calculations, we're not taking into account so many things that they still have to pay for. And with gas prices where they are nowadays as well, that just complicates things even more.
Mm-hmm. Yeah, swimming lessons for the kids, horseback riding for the kids, like those things aren't on a mortgage application.
Yeah, well, it's sports
And
costs for
so
kids. It's some of these costs for the extracurricular and outside activities are quite high. So it can really change somebody's living situation based on what they could afford and what they can afford. So, we try and counsel where we can, but yeah, there's a lot of difficult conversations, and, it's disheartening to people. But at the end of the day, things will normalize at some point. Housing values have kind of had that trend downward. I don't necessarily think we're really at the bottom yet, but we got to be close. And the Bank of Canada is doing everything they can to keep the prime rate in check. It's this conflict in the Middle East that is driving up the fixed rate. So, we just need some things to get resolved, and then hopefully things will normalize.
Yeah, yeah. So you did talk about refinancing, people making improvements on their home. Do you want to talk a little bit about what that looks like?
Yes.
How that works?
Yeah, again, it depends on their equity position. If they've got a good equity position, then basically we can just do an equity takeout or add a secured line of credit and behind the mortgage so that they can, do the renovations they want. If not, we can try and look at refinance with improvements. That's a little more difficult to do with most lenders. But I'm finding, like, you get people that come and they want to do some improvements. You want to try and counsel them on what improvements actually increase the value. And that as well as like bathrooms, kitchens, great things to do. But, flooring, maybe not as much. People that say, oh, I want to paint my house. Well, that's not doing anything. There's just some things that are more logistically a good investment than others. A pool, for example, people want to renovate to put in a pool, and a pool doesn't add value to a home unless the people buying the home want the pool. I'm sure there's a little bit of value added to it now, but in the past it didn't. So, it's something we're just seeing where people have turned to that alternative as opposed to selling to buy something else because they love their home. They just need to upgrade or make some things a little better.
I've had a lot of clients say to me, well, we want to move to Ingersoll or Kitchener, and I can work remotely, but my husband's going to find a job. Does that have an impact on my qualification?
It certainly does. Yeah. I just had one where clients were moving from Nova Scotia to Ontario, and he was working, she was being transferred, and she could work remotely. It qualified on her, which was great. And him, he'll find employment here. We just couldn't use that income, even though there's a track record that he's always working. You lose that income component unless there's employment secured where you're moving to. So, that is very important, and that's something that should be addressed with the broker or lender. Same thing. You get some people who, let's say an individual's been a contractor for, 10 years with this company and decides to go out on his own, and he's only been doing it for 3 months, or he's going to make that change. Well, it totally changes the approval itself. So you always got to have that conversation, that dialogue, and we encourage it. It's the ones that don't talk to us or don't ask questions. Those ones make me nervous. There's no dumb questions when it comes to financing or real estate purchasing, and I think you'd agree that you'd rather them ask the questions than stay silent.
Oh, 100%. And what I really like, Mike, about working with you is that you're available. If my clients have questions, you're available to them and answer your phone, which is so important. So I'll have clients call me up and say, okay, I'm moving, my mortgage isn't up for a while. I'm with TD, or I'm with Scotiabank, or I'm with whoever. And what are my next steps? And my suggestions always are you working with a mortgage broker? I think it's in your best interest to reach out to a mortgage broker. I know you work with a variety of lenders. So if someone currently has a mortgage on their existing property with a bank, are you able to still help them out at your end as a mortgage broker?
Yeah, typically we can, depending on which bank it is. Not all banks are in the broker channel, but, BMO, TD, Scotia, they're all in the broker channel. So we can work with them as well. And, some people are just more comfortable dealing with the branch because they've dealt with the branch for 20 years. But I can bet you that their contact at the branch has changed multiple times over that 20 years. Whereas, you deal with me, I'm still here. I don't plan on retiring anytime soon, so we can. And sometimes, it's our advice is, hey, maybe it makes sense to deal with the branch for whatever reason. And if that's the case, I give them my honest opinion, go back to the branch. Sometimes the branch will offer a better rate than what we can offer through the same lender, so there's situations where it may make sense to direct them back to the existing lender, but otherwise it may not make sense to stay with that lender anyway. If we're getting a new rate somewhere else that's a lot better, even with a penalty to break the existing mortgage, we can show them the benefits and how much they'll save. Like we give our honest advice, and that's what you should be looking for with any transaction is, are you getting the best deal? And sometimes it's not always about rate. That's my biggest bone of contention is we get the calls. What's your best rate? Well, the best rate, you can go online and find it. And there's some brokers out there that they offer the lowest rate, but their service might not be, ideal. Or you may be getting a product that's stripped away of prepayment privileges and, different features that are going to be beneficial if life happens. So, it depends on the situation. But yes, we can deal with some of the banks locally if they're dealing with one already.
Well, and Mike, to be honest, that's another thing I really appreciate about you is I know that I've had a couple of clients now who have reached out to you, and you did make that suggestion to them that they go to their lender and that they would likely be able to get a better rate with their lender. And in both circumstances, my clients called me and said, I can't believe that. Like, who does that? So it's great that you are honest and that you give them your opinion. And I tell my clients, like, especially first time home buyers that don't know a whole lot about, if they get pre-approved or how much money they need to make and all of those questions, it's worth a phone call.
Yeah.
I just make the call Mike, and he'll tell you what you need to do in order to get there.
And I'd like them all. Believe me, I'd like every deal I can get. But at the end of the
Mhm.
day, sometimes I'll just arm them with questions to go back to their lender with. Or sometimes their lender will say, we'll give you this, but if you can find a lower rate, go get it, and then we'll match it. So you just have to reposition to the clients. Like, how is that helping you? They're making you do work to get something that they know is out there. So I'm not always, the local lender's best friend. Some of them probably don't like me, but it's the reality is that if they want your business bad enough, then give them the best rate up front. That's what we do with our clients. It's, that's the name of the game. We're trying to help them save money and give them as much flexibility, and, their lender should do the same.
Yeah, and you have the ability to shop around, right? Like where if you go to a bank, they have their rates, and which I'm sure they negotiate sometimes, but you're in a position where you have multiple lenders you can go to look at and try and find them the best rate and the best mortgage.
Yeah, we've got quite an arsenal of lenders. A lot of them you can only get through brokers. Some of them you may have never heard of, but you're an asset to whatever company lends you the money. So there's no downside to doing it. It's just a different way of thinking. The best part too, they don't have to pay us for our services. If it's standard financing, we're getting paid by the lender. So I don't really care which lender it goes to, provided the client's getting the best rate with the most flexibility. And that's key. And then they always have me as a point of contact after. So, regardless of who I do the mortgage with, they can talk to an individual at that institution. Most of them have broker or lender or client portals now, or they can talk to me. My service doesn't end when the deal closes. It's for the life of the mortgage if they need it. And I've got some clients that I've been doing, 4 and 5 and 6 mortgages for over the life of their mortgage because they trust in the process. And that's all we ask is that, if you're going to work with us, stick with us. We're going to do right by you, and we're going to get you what, you deserve.
Yeah. Yeah. Well, we're really fortunate to be in St. Thomas right now. We've got this new loan program out for people that need some assistance saving a down payment. I know you have some familiarity with that loan program. I'm wondering if you can touch on that for our first-time home buyers that, might have decent jobs, but just don't have the down payment.
Yeah. So each municipality seems to have some funds right now, the affordable housing program or down payment assistance program. And it's a pretty simple process. They'll give you up to 5% for your down payment, up to purchase price. The max is $500,000 in St. Thomas under this program. As far as income goes, there's a single family income or single income and then a family income. I think it's 113 and change for one individual and 135, I think, for two individuals, let's say, that are buying. So if you find a home, then basically the government's going to give you that $25,000 down payment. You still have to save your closing costs, but people can typically do that. And then on closing, what happens is those funds are sent to the lawyer, the mortgage funds from the lender to close your transaction. Key points to it basically is that if you stay in the home for 20 years, it's forgiven. So that's $25,000 free money. Now, most people say, well, 20 years is a long time, and it is. But I could tell you, I built my house 18 years ago, so it goes by pretty quick. If you decide to sell the property, or you decide that you're no longer going to live in the property, or there's default, well, then the funds get paid back, and it's the principal plus 5% of the capital gains for properties that have increased in value. But it can get you into the market quicker. So it's a pretty straightforward process. One, they want you to be pre-approved because obviously that's important. You can't get approved. There's no sense applying for the program. And once you got that, there's a form that you fill out and it's pretty straightforward. You send the information in. I think you have to send income docs as well. And then they'll tell you if you're approved. And if you're approved, okay, you've got your $25,000 down payment. So definitely something that first-time buyers who are thinking of getting into the market didn't think it was possible. It's worth investigating 100%. And it's there until the funds dry up. So that does happen. I have an office in Woodstock and, we've used it a lot over the years. And, I've seen people where it gets paid back. And then if I reach out to them and say, yeah, those funds are still available. So I don't think the program necessarily has ever gone away. It's just, it loses steam and there's not as much publicity about it because, once the funds dry up, then typically, you don't hear any more about it. So, but I would recommend this program. Anybody sitting on the fence, now's the time to do it. And I'm sure Jeff can tell you that there's properties in that 500,000 price range. There's decent properties. It may not be your one that your dream home, but at the end of the day, it's a home, and it can be a stepping stone to buying that dream home, down the road.
Oh, it is. I think it's an excellent program. I know the City of London started it up a while ago. We've just recently brought that program here. I haven't had any clients. I don't know. I tried to post it out on my social media platforms to let people know that program was there. And it's for anybody looking. You can buy a detached home, a semi-detached home, a townhouse, a condo. Like there's so many good options out there right now because our values are down, that, people have some options to shop.
Yeah.
So
yeah,
it's certainly a good program.
Yeah, I'm surprised there hasn't been more publicity on it and more people taking advantage of it. I've got a couple of people that have inquired about it, so that is good news. It's positive. But the more you and I talk about it, and other people in the market talk about it, I think it will steamroll a little bit. But it's just making sure they understand all the terms and conditions to it.
Mm-hmm. Yeah, and it has to be. It has to be a property. They can't use it to buy an investment property. It has to be a property that those people are going to be living in as their primary residence in St. Thomas. And I think that it's fantastic. I really do hope more people take advantage of the program. And, if I get some calls, I'll certainly send them for pre-approval. If people want to reach out to you, what's the best way to get in contact with you?
There's a few different ways they can get in touch with me. Easiest way where it has all my information is just go right to my website. It's bankonyourbroker.com. There's no dots or dashes in any of those words. So just bankonyourbroker.com. You have my email address there. You can reach me by cell phone if you want as well, 519-870-4183. One way or another, you'll get in touch with me. If for whatever reason I can't answer, I do try and get back pretty quick, as Jeff said. He and I've had conversations when I'm on holidays, so I'm never truly off the grid. My response times may be a little delayed at times just because I also have a life. But at the end of the day, yeah, I'm available pretty much all the time. Thanks for having me, Jeff. Appreciate it.
Each week at the end of my podcast, I'm going to be focusing on a small business here in Elgin County. And this week's small business is called the Succulent Shed. It can be found at 34 High Street in St. Thomas. And the owner, Lauren, with her husband, started this company in 2018. They have a beautiful backyard with a greenhouse, and they specialize in succulents, tropical plants, cacti, shrubs, herbs, and so much more. If you haven't been there yet, you need to check them out. You can find them online on Instagram, their website. It's a great place to go. I actually popped in and bought some gift certificates for Mother's Day this year, and they really, really liked them. So if you get an opportunity, stop there and check them out. And if you're interested in being a part and being featured at the end of my podcast for a small business anywhere in Elgin County, feel free to reach out via email at jwest@streetcityrealty.com. You can find me on social media as well. So it was great talking to Mike today, and I hope you learned a lot, and let's get closing. Thanks so much. See you next week.